The phrase, "these ETFs survive recessions better than stocks," needs to be understood correctly because no ETF is immune to recessions. If someone tells you an investment never goes down, they are either ignorant or lying. What actually separates recession-resistant ETFs from regular stocks is how they behave under stress. In a U.S. recession, individual stocks fail for very specific reasons: excessive debt, collapsing demand, poor management, or lack of pricing power. ETFs, especially well-constructed ones, reduce this single company risk by spreading exposure across hundreds or thousands of businesses or government-backed instruments. That diversification alone dramatically increases survival odds when the economy contracts and capital becomes scarce. In recessions, the U.S. market does not reward growth stories or future promises. It rewards cash flow, balance sheet strength, and reliability. That's why broad, high-quality ETFs tend to outperform individual stocks during economic downturns. An ETF, like one tracking the S&P 500, doesn't depend on one company being right. It depends on the continued functioning of the U.S. economy itself. During recessions, weaker companies are pushed out, stronger ones gain market share, and index ETFs automatically rebalance over time. This self-cleaning mechanism is one of the most underrated advantages ETFs have over stock picking, especially when conditions turn hostile. Another category of ETFs that historically survives recessions better than stocks is U.S. Treasury bond ETFs. During recessions, fear rises, growth slows, and investors rush toward safety. U.S. government debt is still viewed globally as one of the safest assets available. ETFs that hold treasuries benefit from this flight to safety because capital moves into them as it exits equities, while stocks are repriced downward due to falling earnings expectations. Bonds are repriced upward due to falling interest rate expectations. This opposite behavior is not accidental, it's structural, and it's why bonds have been a core recession hedge for decades in the United States. Dividend-focused ETFs also tend to survive recessions better than individual stocks because they emphasize business quality over speculation. Companies included in these ETFs usually have a long history of profitability, disciplined capital allocation, and sustainable payout ratios. During recessions, stock prices may fall, but dividends often continue, providing investors with ongoing income even when market sentiment is extremely negative. This cash flow changes investor behavior in a powerful way. Investors receiving income are less likely to panic and sell at the bottom, which increases long-term survival and recovery potential. Defensive sector ETFs are another critical component when discussing recession survival. Industries like healthcare, consumer staples, and utilities do not depend on economic expansion to function. People still need medicine, food, and electricity regardless of GDP growth. ETFs that focus on these sectors tend to experience smaller drawdowns during recessions because their underlying businesses maintain relatively stable demand. While they may not outperform aggressively during bull markets, their ability to lose less during downturns plays a major role in long-term compounding. One of the biggest reasons ETFs survive recessions better than individual stocks is liquidity. In recessions, liquidity dries up fast. Stocks with low trading volume can collapse simply because buyers disappear. Large ETFs, especially those tracking major U.S. indices or treasuries, remain liquid even during extreme stress. This allows investors to rebalance, adjust allocations, or raise cash without being forced into terrible prices. Liquidity is invisible during good times and priceless during bad times, and ETFs generally offer far better liquidity than most individual stocks. Another overlooked advantage is rules-based discipline. ETFs don't panic. They don't react emotionally to earnings misses or headlines. They follow predefined rules. When a company weakens, it eventually gets removed. When another strengthens, it gets added. During recessions, this systematic process quietly improves portfolio quality, while individual investors are often making emotionally driven decisions that damage long-term results. This is especially important for U.S. investors who are exposed to constant financial media noise during downturns. It's also important to understand that recession-resistant ETFs don't just protect downside, they also position investors for recovery. Historically, the strongest rebounds come from assets that survived intact, not from those that were wiped out. ETFs that hold diversified exposure allow investors to participate in the recovery without needing to guess which individual stocks will come back strongest. When the U.S. economy stabilizes and growth resumes, these ETFs rise with it, often faster than investors expect. Many investors assume that surviving a recession means sacrificing long-term returns. That assumption is wrong. What actually destroys returns is permanent capital loss, not temporary volatility. ETFs reduce the probability of permanent loss by avoiding overconcentration and company-specific failures. Over multiple market cycles, this survival advantage compounds quietly but powerfully. Avoiding a catastrophic mistake matters more than capturing every upside opportunity. Another critical factor during recessions is time. Recessions don't last forever, but poor decisions made during them can last decades. ETFs are tools that buy you time to let markets normalize, earnings recover, and confidence return. They allow investors to stay invested without needing perfect foresight. In a system as complex and unpredictable as the U.S. economy, that flexibility is a massive advantage. At this point, it should be clear that ETFs survive recessions better than stocks, not because they are stronger individually, but because they are structurally designed to absorb shocks. They spread risk, enforce discipline, maintain liquidity, and align investor behavior with long-term outcomes. This combination is extremely difficult to replicate with individual stock picking, especially under emotional pressure. Another point most investors misunderstand during recessions is the difference between volatility and risk. Volatility is how much prices move. Risk is the chance of permanent loss. Individual stocks can look cheap during a recession and still go to zero because their business model breaks. Debt becomes unmanageable, or demand never comes back. ETFs dramatically reduce this kind of irreversible damage because they are not dependent on any single company surviving. Even if dozens of companies inside an ETF struggle or fail, the structure of the fund allows stronger companies to replace weaker ones over time. This is why ETFs are not just diversified. They are adaptive, and adaptation is critical during economic stress. In U.S. recessions, access to capital becomes harder. Credit tightens, borrowing costs rise, and unprofitable companies suffer first. Many individual stocks that performed well during easy money environments collapse when financing dries up. ETFs that focus on profitable, established businesses naturally tilt away from these fragile companies. This is especially true for dividend-focused and quality factor ETFs, which screen for financial strength, earnings stability, and balance sheet health. These characteristics are not exciting during bull markets, but they are invaluable during recessions when survival matters more than growth narratives. Another reason ETFs hold up better during recessions is tax efficiency, which most retail investors completely ignore. During volatile periods, frequent trading in individual stocks can trigger capital gains taxes at the worst possible time. ETFs, by design, minimize taxable events through in-kind redemptions and lower turnover. For U.S. investors in taxable accounts, this means less friction and more capital staying invested when it matters most. Over multiple recession cycles, this tax efficiency quietly compounds into a meaningful advantage. Recessions also expose emotional weaknesses in investors. Fear, regret, and hindsight bias intensify when portfolios are down. ETFs help counter this by simplifying decision-making. Instead of asking, should I sell this stock? Should I buy that one? The investor only needs to decide whether to maintain or rebalance a diversified position. Fewer decisions reduce the chance of emotional errors. In investing, simplicity is not laziness, it's risk control. It's also worth addressing a common misconception that owning ETFs means settling for average results. In reality, avoiding catastrophic mistakes puts you ahead of most investors. Studies consistently show that the average individual investor underperforms the market largely because of poor timing and emotional decisions, especially around recessions. ETFs don't outperform because they are smarter. They outperform because they keep investors from doing stupid things at the worst possible moments. Another structural advantage ETFs have during recessions is transparency. You always know what you own. There are no surprise earnings collapses tied to one company, no overnight scandals wiping out 40% of a portfolio. This transparency builds confidence, and confidence is critical when markets are under pressure. Investors who understand their holdings are far more likely to stay invested through downturns than those holding opaque or overly complex positions. For long-term U.S. investors, recessions should be viewed as stress tests rather than disasters. The purpose of a portfolio is not to look impressive during expansions, it's to survive contractions. ETFs that survive recessions better than stocks do, so because they are designed with this exact purpose in mind. They trade explosive upside for durability, consistency, and recoverability. Over decades, those traits matter far more than short-term outperformance. Another subtle but important point is that ETFs allow investors to scale exposure rationally during recessions. Instead of betting aggressively on one idea, investors can gradually increase exposure to broad markets, defensive sectors, or bonds as conditions evolve. This staged approach reduces timing risk and improves long-term outcomes. Trying to call the bottom with individual stocks is one of the fastest ways to destroy capital during a recession. It's also important to acknowledge that not all ETFs are recession-resistant. Leveraged ETFs, thematic hype funds, and narrow industry ETFs can perform worse than individual stocks during downturns. Recession-surviving ETFs tend to share common traits: broad diversification, strong liquidity, low costs, and exposure to economically resilient assets. Ignoring these principles turns ETFs from a protective tool into another source of risk. At the core of all this is one uncomfortable truth. Most investors don't fail because of bad markets, they fail because of bad behavior. Recessions amplify behavioral mistakes. ETFs reduce the need for constant action, which directly reduces the opportunity to make those mistakes. This behavioral edge is one of the strongest, yet least discussed reasons ETFs outperform individual stock strategies during economic downturns. And this brings us to the deeper question U.S. investors should be asking, not which ETF is best, but which structure helps me stay invested when it's hardest. Because the best performing investment on paper is useless if you can't hold it during a recession. As a recession deepens, the investors who come out strongest are rarely the ones who predicted it correctly. They are the ones whose portfolios were built to absorb uncertainty. This is where recession-resistant ETFs prove their real value. They are not designed to avoid downturns, but to prevent downturns from forcing irreversible decisions. When portfolios are structured around diversified ETFs, investors retain flexibility, the flexibility to rebalance, to add capital gradually, or simply to wait without panic. That flexibility is the difference between temporary drawdowns and permanent financial damage. One of the most overlooked benefits of ETFs during recessions is how they align with long-term economic reality. The U.S. economy does not grow in a straight line. It contracts, resets, reallocates capital, and then expands again. ETFs track this evolution automatically. They don't cling to outdated winners or over-leveraged companies. Over time, they rotate exposure toward businesses that survive and adapt. Individual stock investors often fall in love with ideas. ETFs follow outcomes. During recessions, outcomes matter more than stories. Another critical advantage ETFs provide is consistency across cycles. Recessions rarely look the same. Some are driven by financial crises, others by inflation, supply shocks, or policy tightening. No single stock or sector protects against all scenarios. ETFs, by spreading exposure across many variables, reduce reliance on any one narrative being correct. This is especially important for U.S. investors, where macroeconomic conditions can shift rapidly due to changes in monetary policy, fiscal spending, or global events. It's also important to address expectations. Recession-resistant ETFs will still decline in value during economic contractions. The difference is magnitude and recovery. Losing 15 to 25% and recovering within a reasonable time frame is fundamentally different from losing 60 to 80% and hoping a single company survives. Over decades, the math favors the portfolio that loses less because it requires less growth to recover. This asymmetry is why downside control is a powerful long-term strategy. For investors building wealth over time, recessions should not trigger abandonment of the market. They should trigger discipline. ETFs make discipline easier because they remove unnecessary complexity. Instead of guessing which company will rebound or which sector will dominate next, investors stay broadly exposed to the parts of the market that have historically endured. This approach doesn't feel exciting, but excitement is rarely rewarded during economic stress. As the recession ends and recovery begins, the benefits of ETF survival become obvious. Capital flows back into risk assets, earnings stabilize, and valuations expand. Investors who remained invested through diversified ETFs participate fully in this recovery without needing to reposition aggressively. Those who exited the market often re-enter too late, missing a large portion of the rebound. This pattern has repeated across multiple U.S. recessions, and there is no reason to believe future cycles will be different. Ultimately, the reason these ETFs survive recessions better than stocks comes down to structure, not prediction. They reduce concentration risk, maintain liquidity, enforce discipline, and align investor behavior with long-term success. In an environment where uncertainty is unavoidable, these characteristics are more valuable than any short-term performance edge. The market will continue to experience recessions. That is not a flaw. It is a feature of capitalism. The investors who succeed are not the ones who avoid downturns, but the ones who are prepared for them. Recession-resistant ETFs provide a framework that allows investors to stay invested, stay rational, and stay positioned for the next expansion. That's the real advantage. Not surviving the recession emotionally, but emerging from it financially intact and ready for growth.